The final cost is the advisory cost, and this is the cost that you pay the advisor for her or his services. And these costs vary widely. There are actually 4 different compensation models for paying an advisor for the value that they bring you. The first is the commission-based model. Under this model, you are paying the advisor based on the transactions that you execute. For example, buying a mutual fund, such as an A-share mutual fund that will pay an upfront commission to the advisor, as well as a much smaller but ongoing trail commission to that advisor. One of the benefits of this model is that if you simply have a small number of trades over a long period of an investment horizon, you might actually save money by paying the upfront commission if you need no advice or very minimal advice over many years versus paying a percentage of the assets under management on an annual basis. Largely, this is driven by the type of product that the advisor is introducing you to, and it also really should be driven based on your true fiduciary financial planning needs. For example, if you have a young investor who has a very long-term time horizon and will likely not need much in the way of investment advice, it might actually cost that individual less to pay the upfront commission and the smaller ongoing trail commission for that particular holding because she or he may not need any advice over the years. One of the cons of this particular compensation model is that the broker, as they're referred to in this case, may be incentivized to transact more in your account. And given the much smaller ongoing trail commission that is paid to the advisor, the broker may not be incentivized financially to give you much, if any, ongoing financial advice and outline many of the different tax, estate, and financial planning strategies for which you are eligible that can bring a lot of value to your estate. The second compensation model is what's referred to as the assets under management, or AUM model. This is a very common model in the financial advisory space. And under this model, the investor pays a percentage of their assets under management as an ongoing compensation to the advisor. And the idea here is that there is a mutual alignment of interests such that because the advisor is incentivized to provide ongoing investment management and financial planning, that the advisor is providing continual and ongoing services and bringing the estate value on a regular and routine basis. And keep in mind that the advisor's compensation is tied to the account value. So if the account value goes down, the advisor makes less, and if the account value goes up, the advisor makes more. Now, many financial advisors offer this model under a tiered structure where, for example, the first million might be at 1%, and then each additional million tiers down in cost structure. The idea there being someone with $5 million has a certain set of planning opportunities and financial planning strategies idiosyncratic to that profile and will need more time and they'll need more value than someone with, say, $500,000. One of the cons of this model is that advisors who charge via an AUM structure may only be providing you investment management and not bringing value by way of the financial planning strategies such as tax alleviation strategies, risk management strategies, estate planning strategies, and the like. And if that's the case, the investor might be overpaying relative to the value that they're getting. There's also the observation that some advisors might not be incentivized to continually look at the portfolio because they're getting compensated on a regular routine basis from that account. The third compensation model is the flat fee model. And I jokingly tell people that this is like retaining an attorney, but way warmer and fuzzier. Under this model, the client retains the advisor to provide value by way of looking at estate planning documents, tax returns, obviously investment account statements, all risk management policies that are in place, and ultimately a household balance sheet if they have one. Under this compensation model, the advisor is more or less a consultant on a per project basis, and ultimately it boils down to providing value by the hour. Typically, the advisor will project the amount of time that it will take, depending on the engagement, and thus the retainer is solidified. One of the pros of the flat cost retainer model is that the advisor typically does not ask the client to move her or his assets to the firm, which can be a source of relief for clients that are either self-directed investors or for clients that have a current advisor but are simply looking for a second opinion. Another pro of this model is that if the client's account value grows substantially over time, the annual cost of that retainer does not necessarily grow along with the account. For fee-conscious investors, this model might have some appeal. One of the cons of the flat retainer or flat cost model is that the advisor has been paid up front. So if a market event happens that requires immediate action at the portfolio level, if the advisor does not have those assets in-house, it might not be front of mind to take the aforementioned action. Another con of this business model is that if the advisor has been paid up front, some advisors might not be fully incentivized to do as deep a thorough dive as they would if they were being compensated under a different model, such as by the hour, for example. The last compensation model is by the hour. And under this model, financial advisors will charge anywhere from $75 to even $500 per hour, depending on their experience and expertise in the value that they'll be bringing to the client. One of the pros of this model is that the individual investor pays for, quite literally, the time that they have the financial advisor working on their behalf. There are many advocates to this business model, often among what we call validators. A validator is an investor who will pick and choose the investments in their portfolio, but wants the planning expertise that a financial advisor has, and quite simply is there to validate and or guide that investor to make sure that all planning strategies that the person is eligible for have been implemented within their estate. One of the cons of this model is that some financial advisors might be incentivized to simply rack up more billable hours, which is not uncommon under that compensation model in any industry. Now that we've talked about the 4 compensation models for hiring of financial advisors, let's take a moment to talk about robo-advisors. A robo-advisor is a computerized, algorithmic provider of investment management and financial planning services. And just a few short years ago, there was speculation that robo-advisors would completely take out all of the human beings that are providing investment management and financial planning advice. And that's not what we've seen. Because at the end of the day, the one thing that many investors want is something that they can't have when they're working directly with the computer, and that is the human connection. Robo-advisors have become a widely debated topic within financial services, particularly popular among millennials and the younger generation because it's very simple to delegate the investing on your phone and have that done by a computer. But with a few quick questions and a little bit of due diligence, we can think about the gaps that exist in the industry. For example, can a robo-advisor ask you, what are your true passions? What are the things that are most important to you and your family? What would you like your legacy to be? What is the Schedule D on your tax return? And how should your taxable portfolio be constructed so that we eliminate any unnecessary potential capital gains tax drag? Are you on the cusp of a particular tax bracket where we conduct tax loss harvesting, for example, we might be able to get you into a lower tax bracket on a particular year? What potential charitable intent do you have? And is there a way to take some of the highly appreciated positions in your taxable account to satisfy those in a tax smart, tax deductible way and bridge the gap between the tax and investing worlds? One of the points of intrigue about robo-advisors is their lower cost. It's often said in life that you get what you pay for. And I'm not here to advocate paying a financial advisor a higher fee. What I am here to share is that it's really important that you understand your true needs and whether or not a robo-advisor can provide you with the services and strategies that you need given your unique profile. Ultimately, your financial picture is more than just investments. The question to ask is not, what are your fees? This is like walking into the grocery store and asking the same question of the manager. What you want to ask a financial advisor is the following. Based on your review of my overall fact pattern and profile, what strategies are in my best interest? What products are in my best interest? What planning gaps do you see in my estate and how can you fill them? Are you a transparent fiduciary? And ultimately, what will be the cost for the value that you're going to bring me? Remember to ask the advisor in writing to delineate all of the associated costs that we've discussed today. And that way you can have the confidence and the clarity to understand what you're paying for with respect to the value that you'll be gleaning.